Thank you for joining us for the New Capital webinar, Special Markets Update 2020, number 3. This is Catherine Barr, Director of Communications at New Capital. If you have any questions during the presentation, you can enter them using the Q&A tool. It should be at the bottom of your screen in the webinar menu. Leonard's going to answer any questions you have at the end of the presentation. So before we get started, I'm going to make the following regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Okay, thank you, and I'm going to pass it over to Leonard.
Thank you, Catherine. Welcome, everybody. And thank you for being here this evening with us. I know this is a very, very difficult time for everybody all over the world. And for all of us as a community of people and for all of us as individuals in the way that we are situated in our own lives, in our own families, in our own finances. And it is my privilege and my honor to be here with you through all of this. And so thank you very much for being here tonight. I wanted to start with a story. It's a story I think I've told before, but a long time ago. And whenever the shit hits the fan, I like to tell this story. It's a Zen story. And so here it is. There is a story of an old farmer who had worked his crops for many years. One day his horse ran away. Upon hearing the news, his neighbors came to visit. "Such bad luck," they said sympathetically. "Maybe," the farmer replied. The next morning the horse returned, bringing with it 3 other wild horses. "How wonderful," the neighbors exclaimed. "Maybe," replied the old man. The following day, his son tried to ride one of the untamed horses, was thrown and broke his leg. The neighbors again came to offer their sympathy on his misfortune. "Maybe," answered the farmer. The day after, military officials came to the village to draft young men into the army. Seeing that the son's leg was broken, the army passed him by. The neighbors congratulated the farmer on how well things had turned out. "Maybe," said the farmer. So I hope that is a good story that helps everybody think about how when we think that something is bad or we think that something is good, we don't really know what the eventual outcome will be. And the current crisis of this virus that is ravaging the health of the world's people and ravaging the finances. We have a financial contagion as well as a health contagion. I hope that story helps put into perspective because I think it's true. There will be many negative things that come out, but there are also going to be some positives. I truly do believe that. I know it's hard to see right now. In my judgment, this is the crisis that the world has sort of been waiting for, if you will, and how we handle it and deal with it is going to tell a lot about the future. It's great to be with you. I'm in Colorado right now. You may be able to see behind me. It is snowing, and it's very beautiful here. And I hope that everybody will take some time as well to get out into nature, because as we're all facing quarantines and lockdowns, open space in nature really is one of the things that offers us the chance to be ourselves again. And our family is really, really lucky to be here in this beautiful place. It's been snowing for the last couple of days. And here's a scene from yesterday. One of the places we really love here in Breckenridge, Colorado, where we come, is the cross-country skiing center. The entire mountain is shut down. Vail Resorts is a very successful company that owns not only the Vail Ski Mountain, but Breckenridge Ski Mountain and Park City Ski Mountain and Whistler in British Columbia. It's by far the biggest ski resort company in the world. And of course, its stock has been absolutely hammered. The mountain here is shut down, which means that the town is essentially shut down as well. And it's a very strange time to be here, because normally the slopes would be full and you would hear the snowcats on the mountain. But it's an incredibly, incredibly quiet scene here. And our friends at the Nordic Center, where we like to go, the cross-country center, we don't only like to downhill ski, but we also like to cross-country ski. We're incredibly generous. It's a good thing we knew them, because they said, we will sell you trail passes and we will rent your kids skis. The kids didn't have skis. And there they are yesterday. So I'm hoping that everybody will find a way to find some personal time and personal happiness in places that can give that to you. It's not all about the virus, and it's not all about the markets right now. There are other parts of our lives that it's very important that we exercise and that we find. And I hope that you'll do that. Here was the scene this morning. We had a break in the snow early this morning, and this is the scene from the house. And I mean, look at that. It is incredible. And the crisis that upon us is a crisis that Mother Nature is bringing, this virus. And so I think it's important that we also recognize that Mother Nature is also this incredibly, incredibly beautiful source of peace and happiness that we can find during this difficult time. Before I get into the heart of the presentation, and I want to tell everybody right now, I don't know how long this presentation is going to go. The first, number one of the seminars that we had a couple of weeks ago, it went long, and some people said it went too long. The second one didn't go long, but it was technical, and some people said it's too technical. I'm just doing the best I can to make it real. If you got to drop off, drop off. And if you have a question that you didn't have time to get to, just send it in or type it in or email it to Catherine, and we'll get to it. But I'm going to do my best to get through the slides. We're probably going to have a lot of questions, and I'm just not giving any promises about when we're going to wrap up tonight. I myself have been sitting in on a lot of conference calls, and it's just the way it's going these days. I've now spent 15 years building a business, and every time I pick somebody to do business with, I think about it very, very carefully. I want to make sure that there's a good reason we're doing business, and you find out whether you have made the right choices during times like this. And I want to tell you all that I cannot identify a single choice that we've made in business partners that hasn't been right. I am really, really pleased. Fidelity has done everything that they need to do on the administrative, trading, clearing side of things. When we've had questions, when we've had issues, and we've tried to find something out, they have been right there. All trades have gone through without any problems, and your money is very, very secure at Fidelity. Mine is too. It's in the same place yours is. And I cannot say enough about Fidelity and the quality job that they're doing. JP Morgan, I amped up the business that we're doing with JP Morgan a couple of years ago, and a couple of funds that I bought, their core bond fund and their government bond fund, have done fabulously. I don't like all the funds that JP Morgan does, but I really like those two bond funds, and they really have done well. There's something else that JP Morgan brings, and that is they just got their finger on the pulse of a lot of stuff. You know, it's a huge bank, and they've got some real good market thinkers, and I want to thank them very much for the different resources that they've made available to me, not to the public, but to me as an advisor over the last several weeks to help me think about and get my mind around certain things. They've been really, really helpful. Dimensional Fund Advisors, obviously, I use their funds a lot, and they have been fabulous to deal with in the last few weeks. Any trades that we've had to execute, whether on the buy or sell side, they've come through with flying colors. They have a very sophisticated trading operation. And another thing that we're getting by being shareholders in Dimensional Funds is that every one of their shareholders also have advisors like New Capital. And so your funds are commingled with other investors who aren't going to panic, aren't going to flee, aren't going to misbehave, and are going to be with their advisors. And so there's not going to be a flight from the funds that you own, which isn't going to cause pressure on DFA to sell funds at inopportune times. So we're very, very lucky to be part of Dimensional Fund Advisors Fund Complex. Right Capital is a financial planning program that we started using last summer, and I couldn't be more pleased with the results it's giving on the financial planning side. A lot of you, we have updated your financial plans. They do a full lifetime cash flow analysis. So if any of you out there would like to either initiate or update your financial plan, we stand ready to do it. JC got her CFP last year, and we can do it with you remotely. So we can put the screen up on the computer. We can do everything we can do with you in person on the screen. And so if you are concerned, am I going to have enough money to last my lifetime? Right Capital will help us make that determination. Morningstar, the analytical product that we use has been excellent in the recent days. They have updated all of your positions for me every single night so that every morning when I wake up, I'm able to see where things stand, where cost basis stands, what I think of the portfolio, are there any adjustments that need to be made? And so a lot has been done there to continue operation and make sure that we're getting the information that we need. And last, but certainly not least, the staff of New Capital has been absolutely fantastic. Catherine has been working incredibly hard to make sure that our communications are going to you and going to you on a timely basis and in a way that is good and able to be consumed in different ways, whether it's email or whether it's a webinar like this or text messages or whatever it might be. And JC has been fabulous on the administrative side as well. And so we are all working very, very hard. I'm sure that you can imagine, and I just cannot say enough about how everybody's coming through with flying colors. We are working remotely. Catherine obviously was in her breakfast room with her 1-year-old. I'm in Colorado. We are very well trained to work in this environment. We have used all of the tools, and we have been set up to work remotely for many years now. And so this is second nature to us. And we are working absolutely the same way as if we were together in the office, and maybe in some ways even better. Okay, I want to talk about process and what I'm going through so that you get an idea of what's going on in the background. First of all, we are in triage. Just like doctors are in triage, I regard myself to be a financial doctor, and I am going through triage. So one of the key innovations that we've used in the last few days was the email that we sent out to everybody, asking you several questions. And we got an overwhelming response. At least 2/3 of everybody responded to us. If you haven't, please do. There are now other advisors who are using our triage process. And just to give you an idea of what that looks like, I'm going to get out of the presentation here for just a second and go over so you can see. If I go over to the left-hand side of the spreadsheet, it's got names, but I'm gonna go back and take those names off so you can't see them. And with every client name, based on your reactions to the questionnaire that I sent out and to other conversations that I have, we color code you. Are you a yellow, or are you a green, or are you a red in terms of financial condition? Is there anything that you need in terms of cash or any other adjustments that we need to make? Are you in the yellow? Maybe some things are okay, some things aren't. And we have very, very few in the red. I want you to see just a couple of people, 3 out of a whole lot here, are showing some distress. Could be in the job situation or otherwise. So I want you to see that we are monitoring this triage process on a daily basis and updating it. And now we have other advisors. We've made this available to other advisors across the country, and they are using New Capital's triage process. Okay, back to this presentation. Let's see, bear with me. I've got so many tabs open. Okay, back to this. I push this, and does it work? What does it do? Oh, here it comes. Okay. All right. So triage is at the heart of our process right now. I'm heavily focused on liquidity needs. Who needs cash? There is a huge rush for cash right now in the world. And during a crisis like this, cash is king. Not just during this crisis, during any financial crisis, cash is king. Cash is needed to buy assets, cash is needed to pay bills, cash is needed to present as collateral, and so on. And so I'm highly focused on people's liquidity needs and constantly evaluating people's cash positions and do they need more, do they need less, etc. KYC stands for Know Your Client. And I don't think that anybody would disagree that one of the things that we at New Capital are known for is getting to know you. From the beginning of my process, I want to know who you are. Why? For times like this. So I can know what your reaction to market risk is going to be, what your personal needs are, what your goals are. And so I'm constantly thinking, what is it about you that you need right now? And so KYC. We are having a morning meeting every single morning remotely. Catherine, JC, and I are meeting through the same system that we're using right now. We have a morning meeting and discuss who is where, what client needs what thing has come in overnight, where are markets, what trades need to be made, what communications need to be issued. And that happens at 8 a.m. on Mountain Time right now, so that's 8 a.m. Mountain Time and 9 a.m. Central. So don't try to call us then, because we're on our screen then. I do a daily survey of every single client, and that is tied in with KYC. Thinking about you, I go through the entire client roster and think about where you are right now. If something in the market has changed that might have affected you, often there's not, but I just want to make sure that I think about you on a daily basis, that your name crosses my mind every single day. I see your name and I think about you. I may not do anything, there may be nothing that is to be done, but I think about you on a daily basis. That's my daily survey. I'm thinking outside the model, meaning our model portfolios I will break out of right now. If there are things I want to do in your portfolio specifically to raise cash or buy a security, I will not pay attention to the model right now. I'm going straight into the account and doing what I need to do for you so that it's not a one-size-fits-all thing in a model. We will get back to models after sort of all the dust settles. But right now, your individual situation and your individual account is my prime concern. I am loss harvesting. This is giving us a chance right now to take losses in portfolios because the losses have simply developed as faster than they have ever developed. The drop in the markets now is faster even than the drop that occurred back in the 1920s. That's how steep the drop has been. I'm going to show you a graph of that pretty soon. And so we are taking that opportunity to harvest losses in taxable portfolios. And so that may give you a tax benefit, or it may allow me also to take gains against other positions. And that also allows me to upgrade the portfolio. So you may hold a holding that is 10 years old and you've got very large gains in it, but we can't get out of it. Or you may hold something that dates way back that you hold individually, some Coca-Cola stock or whatever the case is. This combination of loss harvesting and upgrading gives me the ability to upgrade the portfolio. When I say upgrade, that means modernize it in the way that I see portfolios right now. And a very good example of that is in so-called ESG portfolios, environmental, social, and governance portfolios. Many of New Capital's clients are inclined toward investing in that way, in an ESG portfolio, a portfolio that would represent a lower greenhouse gas factor in the entire portfolio. But we may not have been able to get there given gains that were built in. But given the current market drop, this gives us an opportunity to, on a tax-efficient basis, move you into that type of ESG portfolio for the future. So that's a good example. Planning reviews. We have been doing, before the crisis and during the crisis, planning reviews with clients, using the right capital system to update where you are and are you going to be okay into the future? Are you going to be able to retire at this age, or will you need to work longer? Given the drop in asset values, what is the effect on retirement or the effect on other financials? And I want to encourage anybody who wants to update their planning, and it is an excellent time to do that. We stand by to do that. Let us know, and we will put you in the queue for doing a planning review. JC is spearheading that. spending a lot of time looking at empirical past results. What do past bear markets look like? Does the current bear market resemble the past bear market? What do past viral outbreaks look like? Does this one look like that one? So that's part of the process right now, to try to get grounded in the reality of the past. It doesn't mean that what happened in the past, of course, is going to repeat now. It never does. But as the old saying goes, it probably rhymes. And so I at least want to hear what the rhymes are. And so that's part of the process now also, is to make sure that we're steeped in empirical past results. And then I think lastly here, we want to make sure that we're communicating with you. I think we're doing not only a good job, but an excellent job. But if we can do anything more or different or better, please let us know, and we will strongly, strongly consider it. Let's talk about investments for a second. Sales. A lot of people have been asking, I'm seeing sales that are crossing the tape in my account. You know, can you help me understand what's going on there? And frankly, I don't have time to talk to everybody right now and have 30-minute, 1-hour conversations. I'm sure you can appreciate that. It's not that I don't want to, but I just can't. We are absolutely, as all our advisors right now, inundated. So let me give you the highlights of what sales look like right now. I am not, generally speaking, selling stocks, because stocks have gone on sale. I don't know what kind of sale they're on. I'll talk about that in a little bit, but I won't be able to tell you exactly. In contrast, bonds have gotten very expensive. And so what I've been selling are bonds. Now, I haven't been selling all bonds. I've been selling riskier bonds. Bonds that are corporate bonds, bonds that are higher risk corporate bonds. Earlier in the year, back in January, I sold out of a global bond fund, Templeton Global Bond, that was investing outside the United States in areas that I wasn't comfortable with. And so, also mortgage bonds, higher risk mortgage bonds. For example, the PIMCO Income Fund, some clients held that from way back. It's a fund that's done extremely well. There's nothing wrong with the fund. There's nothing wrong, for example, with the Fidelity Floating Rate Bond Fund that I've sold. It's just they're in areas that I don't know what the impact of this is going to be on them, okay? So I don't know if we're going to see large-scale defaults in lower corporate credits. And so I don't want you to be left holding the bag if, in fact, that materializes. I don't know if lower credit homeowners are going to miss mortgage payments. I don't want you to be left holding the bag on that. So anything recently that whiffed to me of higher risk in the bond investments, I have sold. Okay? So so that's what's going on there. All right? I'm not selling your stocks, and I'm not de-risking the portfolio from that perspective, so that when, and I think it'll be when, stocks rebound, the growth potential in your portfolio is not going to be there. Now, selling those bond funds has had the effect of raising cash. So to me, that's a double good. I sold something that I was not comfortable with on the risk side and raised cash as well. I want to talk about cash and where cash is going. It's important that everybody understand this, and I've had a couple of clients ask me. The cash is going into a money market fund, the Fidelity Government Reserves Money Market Fund. A money market fund is not an FDIC insured account. I want everybody to understand that. However, it is incredibly, incredibly, incredibly safe. Why? Because the Federal Reserve Bank of the United States is standing and will stand behind any money market fund. How do we know that? Because they did it in 2008. There was one money market fund that so-called broke the buck. The $1 value on the money market fund came off on, it was called the Reserve Fund, and the Federal Reserve stepped in immediately when that happened. The other day, or maybe today or recently, the Federal Reserve has also indicated they're going to stand behind municipal money market mutual funds. There are money market mutual funds that are composed of municipal bonds. They're tax-free. And those are a higher risk than the Fidelity Government Money Market Fund that I have you invested in. And the Federal Reserve has said that it is going to stand behind the municipal money market mutual funds. It has also said that it is going to stand behind prime money market mutual funds, which are often used by institutional investors. And prime money market mutual funds don't only invest in government securities, like the one that I have you invested in, but also in some corporate securities and so on. So if the Federal Reserve is going to stand behind the municipal money markets and the prime money markets, it is going to stand behind, I promise you, the government money market, which is composed of treasuries and other government securities, okay? So that is where, when I make a sale and money goes into cash, that's where it's going, is into that money market. Feel free to ask me if you are not clear about that. Holds, what am I holding? I'm holding stocks. I'm not selling stocks. Bonds have become very expensive. At least government bonds have become, U.S. Treasury bonds have become very expensive. Stocks, as they have sold off so dramatically, represent greater value. But we don't know what value, because we don't know what earnings are going to look like, because we don't even know what businesses are open and closed right now, right? None of us knows. You don't know what up the street is open or closed. So we don't know what earnings are going to look like. But a little later in the webinar, we'll try to take some estimates, and I'll show you what some of the numbers being bandied about look like. Ads. Well, I've added some stocks. I've added some stocks personally for me. I've had some other clients who are very interested in adding stocks. One thing I'm actually have grown interested in adding, I already hold a lot of it, and some other clients do, is Berkshire Hathaway. My belief is that this is going to be the capstone on Warren Buffett's career. Berkshire Hathaway has been holding $130 billion and growing in cash. And he has sat on it and done nothing for years and years as he's waited for values to come down. And obviously they're down now. And I would not be surprised if Berkshire has been incredibly active buying in the markets lately and putting that cash to work. And my guess, Warren Buffett is approaching 90 years old, is that this will be the capstone on his career when he will deploy a vast amount of that cash. And there are other companies with lots of cash. Let's take Apple, for example. We could buy Apple. It has a lot of cash, but Apple is limited in what it can do with that cash. It can't go out and invest in any company, in any industry, public or private, right? It's got to stick to its knitting in technology. Berkshire Hathaway, on the other hand, can buy any company of any size, public or private, in any industry. And so what we're getting there is that, a really, really flexible structure with history's greatest investor. So, and it's a very defensive holding as well. So Berkshire, for example, is something that I'm interested in adding to. I'm also getting very interested, I am interested now in inflation-protected treasury securities, because at some point I think we're going to see inflation. I know that right now the price on everything is falling. I checked the price. The kids in Hannah are going to fly home on the 25th back to Houston. The kids have to start their remote learning. And the price to fly from Denver to Houston, $45. $45 per person. So the price on everything is falling right now. But at some point, I am worried about inflation. And inflation-protected bonds are very, very cheap right now. And I wouldn't be surprised if I come to the conclusion that half of the bond portfolio, if not more, should go into inflation-protected bonds. Stores. What I mean by that is where I'm storing capital, and I've already talked to you about that. That's in the money market fund. I may also add to the storehouse possibilities some very short-term treasury bonds, treasury bond funds. So for example, the Vanguard short-term treasury fund. The problem is there are dislocations going on right now in the treasury markets, and so I want to make sure that that things are hunky-dory there enough to be able to invest in that. Okay, let's look at the virus a little bit. This is mortality rates, COVID-19 versus other diseases. And I think you can see my arrow here. If you can't, sort of send a note to Catherine. But you can see all along the right side are these different mortality rates, ranging from Lyme disease, swine flu, cholera, Spanish flu, which is much talked about these days because of the resemblance of COVID-19 and the Spanish flu that hit 1918, 1919, West Nile virus and yellow fever. And we can see, we can see that Italy, now this is of reported cases, reported. And what we know is that things are underreported, because especially here in the United States, because testing has been so, spotty here in the United States. whoops. So we have high mortality rates that are being reported in Italy, Iran, China over here. Here's China in this column right here. This is the rest of the world, right? And we can see that of what was being recorded in China, in Wuhan, where this began, 5% mortality rates. In comparison to other diseases, it's quite high. So, you know, this is very, very concerning. Here in the United States right here, we're still reporting low mortality rates. And hopefully that's going to stay the case. But right now it looks like we are on a concerning trajectory that may look more like Italy than it does China. And I know that everybody's reading the same news that I am right now, and that we're seeing almost a snuffing out of the virus in China, but not in the case elsewhere. We all know this, that the mortality of this thing is especially high for older people, and especially low for younger people. Very, very low mortality rates, almost none, 0 to 9, very low, 10 to 19, and so on. Starts to bump up here in the 50s. I'm 54, and then of course it really moves up. So these are the high risk categories for this virus. Best guess of what it might look like in the United States. This is from James Lawler at the University of Nebraska. Nebraska. Region 7 Disaster Health Response Ecosystem webinar, estimating a doubling time of 7 to 10 days, community attack rate of 30 to 40%, would result in 96 million cases in the United States. What are we, 320 million people? 4.8 million hospital admissions, 1.9 million cases requiring intensive care. And I don't know what the intensive care bed supply in the United States is, but I don't think it's near that. And I think that's the big concern right now. I listened to a podcast the other day, and in Italy, in northern Italy, where they have absolutely been slammed by this virus, they have had to convert all the surgery centers to intensive care units. So, and they've had to retrain all the dermatologists and heart surgeons and orthopedic surgeons to be able to care for this respiratory condition. 1% of cases revolving ventilatory support, and 480,000 deaths, 500,000 deaths in the United States. This is an estimate. And then the financial estimates, Goldman Sachs, I think this is out today, forecasts a historically sharp and swift recession. And we're seeing this in front of our eyes. It's not like we need Goldman Sachs to forecast this. All of our lives are being shut down and people are now being confined. The news this evening is that 1 in 5 Americans, this is from the New York Times, 1 in 5 Americans are now under quarantine. Second quarter GDP sinking a stunning 24% on top of a 6% decline in the first quarter, an additional 24%. Economists had expected a decline of 5% in the second quarter after a flat first quarter. But they said social distancing measures have affected many sectors of the economy and will hit the first and second quarter hard. The economists still expect a springback in the third quarter, a 12% springback. That's a 12% springback from where it falls to, not on top of where it would have been, but from where it falls to. And they see unemployment peaking at 9%. I think we're going to be lucky to see an unemployment peak at 9%. And what has the response of markets been to all of this? Well, look at this. Here's the S&P 500, July of 2017, right? This is the Trump bump. You may remember the big fall off in the fourth quarter of 2018. That's this. And then we've had this big mini bull market that's occurred. Whomp, right off a cliff. Look at that. One of the steepest declines ever in the US stock market as this virus has burst out onto the world. This is a measure called the panic button measure, and it measures sentiment. And we can see that the panic button measure here, and this goes back to 1954, has only really been equaled or even come close to back during the Cuban Missile Crisis. Look at that. So that's it. Cuban Missile Crisis. What was this? 1970. I don't know what that would have been. This big jump up in 1970, what rattled the markets or so. Something the Vietnam War, maybe, or something the Soviet Union. Anyway, this was the 1987 Black Friday crash when the market fell 20% in one day. And we're now getting used to these massive drops. We haven't seen a 20% fall off, but 5%, yes, for sure we've even seen some 10% down days. And I think everybody's almost getting numb to it, including the opposite volatility as markets have burst up to the upside on several days. And today, we were up pretty strongly to start the day and ended down 2.5%. The market could not hold those gains. Nationwide unemployment claims. So this goes back to 2000, 2002. We can see the big spike up in unemployment in 2008, 2009. And take a look. This is 2020, and we had 281 official claims filed last week officially, but in just 15 states this week, in just 15 states, not 50, 15, 629,000 claims have been filed in only 15 states. And today, the Trump administration asked that the states not release their claims to the public. So we are already seeing claims in only 15 states that are the equivalent of 2009 at the peak. So this is the huge conundrum we are facing right now, and why Congress is racing so fast to try to get a package. What do returns look like for the year to date? They are ugly. This is as of yesterday. Look at this, and I may turn on my. I can draw things here. So let me turn my drawing thing on. All right. You can see that the only thing that's made any money is the 20-plus year Treasury bonds. 20-plus years Treasury bonds. Inflation has beaten everything. Inflation is pretty quiet. I mean, that's on an annual run rate less than 1%. Here is a diversified bond fund, the aggregate bond fund. So that's a combination of government bonds, corporate bonds, mortgage bonds, basically an index fund of major bond types. Gold, down 3%, and in recent days has not held up very well. Municipal bonds. I'm concerned about municipal bonds, not extremely concerned about municipal bonds, but what we've seen in the last couple of days is that there's now pressure on municipal bonds, like there's pressure on gold and other things as well, right? What do we know about municipalities and states? Well, they can't print money. This is why everyone's running to treasuries, because there's only one entity that can print money. It's the federal government. And man, they are going to print money. But the localities, the municipalities and the states can't print money. And so as a result, people are concerned. What if they are not able, what if they're really impacted health care wise and otherwise and unemployment wise and have to provide all these benefits? And we start to see bankruptcies in municipalities, and that hits the bond market. So my major focus right now is in the municipal bond area, because a lot of clients hold municipal bonds. I hold municipal bonds. And so I'm trying to think clearly about what do we do about municipal bonds now that they're coming under pressure? And as people rush to cash, anything that can be sold is being sold, right? And so that's why gold doesn't offer much protection. It can be turned into cash, and everyone wants cash. Global bonds. A conservative portfolio would be down, I don't know, 8% or so. A moderate portfolio might be down 20% year to date. The S&P, all U.S. stocks are down 26%. An aggressive target risk, down 30%. Emerging markets, 31%. developed international like Europe and Japan and so forth, down 31. U.S. commercial real estate has been hammered. Look at that, down 35% as retail stores and office buildings become extremely unpopular in the age of the coronavirus, where people are not going to be getting together to eat and work together. And then here is commodities, and that has been oil, and that has really got to be hitting a lot of people in the state of Texas. And it's going to cause enormous questions for Houston as well. What is going to be the case with Houston? And its reliance on the oil industry. We will have to see about that. Okay, valuations. Let me show you what is being indicated here. What this is showing is that this is what earnings per share, level of earnings per share implied by dividend futures was on January 20th. And this comes to us from Bridgewater, the large hedge fund. And so what they were speculating was that we would see earnings per share above the prior year by some, 3% here, and then by 2026 we would see earnings per share that would have been 10% above a 2020 level, right? You see how that works. So that by 2030 we would have seen earnings per share close to 20% above this baseline here. And look where the pricing on the S&P 500 is today. In other words, the market is now pricing in a steep, look at that, 50% drop, speculating that earnings will be 50% below where they were in 2020, in 2022. And same in 2023 in a slow recovery. This is what is being implied here. So I want everybody to look at this graph, because if you're thinking about immediate quick rebound, that is not what Bridgewater is indicating we're going to see in a future that unfolds based upon current dividend futures in the futures markets. All right? So I want to give you some reminders. Anybody who wants to run out and sell everything and buy bonds and sell their stocks, I want you to remember that the market has already rebalanced your portfolio, right? It's already cut the price of stocks in your portfolio. So if you were 60-40 and the markets have fallen now and you're now 50-50, for you to go out and sell more stocks means you're now going to go to 40-60 or something like that. You get my point. So I want you to be cautious in rushing to sell, because the market has already sold the value down. If anything, the argument is for us to add to stocks, right? That's the quintessential rebalancing. So I want everyone to remember that. The market forecasts. Is it going to get worse? Yes, it's going to get worse. There are going to be more people who are going to get sick. There are going to be more quarantines. But the market forecasts all that. The market sees all of that and is discounting. That's a lot of the reason why we've had this big steep drop in the stock market, because the market sees that. There's some estimates that the market looks ahead 6 months or so, something like that. Okay? So when you say, but it's going to get worse, so the market's going to go down more. Not necessarily. The getting worse is more than likely already in the market price, because the market is a forecasting machine. I also want you to remember, in all cases, always in the past, a bear market and the way you pay for a bear market and the drop in the value of your securities, that's the payment that you make for the next bull market. That's just what that is. I know it's painful, but the clear way to think about it is that when I'm paying this price with stocks moving down in a bear market, that's the premium I'm paying. That's the ticket I'm buying for the upsurge in the market. I don't know when it's coming, but that's the price that we're paying right now. And so if you pay for your ticket, you may as well get to the show. Some random thoughts I'm having. It's a lot. What we've got going on right now is it's a lot. I sent a text message to a good friend of mine the other day who's I've alluded to her before. She runs a very ultra high net worth shop in Houston. You have to have $50 million or they won't even talk to you. And I sent her a note the other day and I said, how are you hanging in there? And she called me right back. And we were just talking and she said, it's a lot. So I want everyone to realize, if you're thinking it's a lot, I'm not going to sit here and tell you it's not a lot. It's a lot. To have a global pandemic going on and a financial crisis, it's a lot. So be kind to yourself and allow yourself to think it's a lot. It's okay for you to feel that way and to think that. And it's okay for you to tell me that and for you to tell anybody else that. It's a lot. We're only human. So you're fine if you think it's a lot, because Lissa and I also think it's a lot. And it takes a lot for us to think it's a lot. We're both pretty, you know, and we both agreed it's a lot. It's a crisis. And we need to use that word. It is a crisis. It's a health crisis. It's a pandemic. We're in a financial crisis. We will get our way through it like we do all crises. For those of you who've been through personal crisis, as we know, there are two sides to the crisis coin, right? There's the difficult side, and then there's the other side, the new side, where we take our learnings and the things we learn, and we go forward in our lives, and that's going to happen in the world too. And there are many, many things, as many of you know, that I have not agreed with the way they've been going on in the world. And it's my hope that this crisis, and I do think this is the crisis we've been waiting for. People thought maybe 2008 was. I think this is the one, because it's so big and it has natural causes. It is Mother Nature talking in many ways. That this is the crisis, and I think it's going to have a very, very big impact on so many things. Okay, next. The business cycle has ended, and we can now state that with clarity. So the old business cycle is over, but I want everyone to think about that a new business cycle is now beginning, right? This is the new business cycle start. And I'm hoping that thinking in that perspective will be beneficial. I want everyone to think about quarantine as an investment. We're making an investment by trying to slow the spread of the virus. We're making an investment in the future, right? We're taking some cost and some pain and paying a price right now. This is exactly what investment is, to pay an amount of money or capital now to get a return later. And so I think it's important that people think about quarantine from the perspective of it being as an investment. I want people to think about markets as a signal. There have been some suggestions that the market should be turned off for 30 days or something. I think it's a terrible idea. In many ways, the markets are the biggest form of democracy that we have on a daily basis right now, as people vote to buy or sell or hold or whatever the case is with their money. And our markets are delivering very, very important insights and responses to us and to our policy makers as well. And it's giving very, very important guardrails to them all over the world in terms of what we as people and investors approve of and what we don't, and what needs to be done, and where fears exist and where fears need to be allayed. And so if anybody tells you that, well, we need to shut off the markets, your immediate reaction should be, the hell with that. If you don't want to see the market, don't look at it. But it would be a huge mistake to turn markets off. We have heroes. We should always recognize heroes. I read something this evening that in Paris, they've been now locked down for 3 days or 5 days or something. And the writer of this was talking about him being cooped up in his apartment with his wife and his 2 kids. And he said it's really, really, I don't know if he said bad or, whatever. It's not fun. He said, but windows are opening in Paris as medical professionals move through the streets, going to their jobs or wherever. And there is applause breaking out all over the streets of Paris for those heroes. We're not going back. This is a fundamentally new era that we are entering, and it's going to have impacts on everything. We are fundamentally not going back. And all of us could go on at length about that, but this is a fundamental new paradigm that the world is going to be living in. We have a very strong dollar right now. If you got money and you want to buy a place in, Mexico, and you can buy it in pesos, maybe going for a song. I don't know how long the strong dollar is going to persist, and I know we can't really go anywhere right now, but at some point the strong dollar may work in our favor. if you are interested in assets outside of the United States being bought in local currencies there. So keep that in mind. There may be some of you that want to retire to some other place. If so, I would be factoring that in. Houston, I don't know what the effect on Houston long-term is going to be given the drop in oil prices. I just don't know, but the city has diversified. A lot of the people on the call are either living in Houston or from Houston. And I don't know what the effect on commercial real estate. There's been a lot of building going on there. I don't know what the effect on residential real estate is going to be. And a lot of us have additional equity in Houston real estate. So we need to be thinking about that. It's something that we should at least be paying a bit of attention to. Infrastructure. I think this is an excellent time for the country to be looking at building infrastructure. I'm not seeing much talk about the long promised infrastructure bill that's going to come through Congress. They're looking more at assistance right now, but this would be an excellent time for the country to undertake large-scale infrastructure projects, and I think you'd see a very positive response from markets. Somebody said this to me the other day: the virus is culling the herd, or culling the human herd. You know, this is what happens when a species becomes so successful and so pervasive, and in many ways not sensitive to the other species of the planet. This is how Mother Nature deals with that. It's with a virus. And so we need to think very, very carefully about how we behave on this planet going forward. And I think that actions we take with regard to climate change and species extinction and so many other things, this is the way that we need to be thinking about the lessons of this. Global correlations. Just as we're not getting perfect correlations in treatment of the pandemic, we're also unlikely to get correlations between economic responses and stock market responses and bond market responses. And so that's going to argue even more for a diversified approach, because, you know, Chile may get it exactly right, you know, but Uruguay may not. So correlations I expect to come even further off. Negatives. We don't have a vaccine. It's really kind of hanging on a vaccine right now. We need to get that vaccine. Consensus is that we're going to get the vaccine, but it's going to be a year and a half, 2 years it could be. And what does that mean? That means that we're going to be in this twilight zone economy until we get that vaccine. Everybody's going to have to get used to this kind of weird twilight zone vaccine. We're not economy. We're not going to be out of that until we get a vaccine. Why? Because even if the virus gets stamped out in some place, the minute one person with the virus walks back in and starts to spread it, you're off to the races again, right? So that's where we're going to be in this muddle that's going to last a couple of years. And I can't predict what securities prices are going to do. We're going to adjust and we're going to learn to do things. And we already are learning how to stand next to each other and talk to each other and what activities we can do with each other. But until we get a vaccine, it's going to be a twilight zone economically. We've had a slow U.S. response. Not blaming anybody for that, but that's just the fact. We should all ask, why did we have a slow U.S. response? Why did we not put resources toward guarding against the pandemic? Why did we put our resources into, you know, another burger joint chain? Why is that where capital flowed from in the United States? You know, the 10th burger franchise, rather than to a pandemic alert system with sufficient testing kits and sufficient masks and ventilators and so on. I don't know the answer to that, but we should be asking that question. Shock unemployment. I mean, this isn't just growing, trickling unemployment. This is shock unemployment, where layoffs are occurring immediately and began to occur. This is incredibly negative, and the country has got to deal with that. In many ways, we as shareholders are helping pay for that. I want you to remember that when a company decides that it's going to put in place a safety net for its employees, whether it's Walmart or something else, we, the shareholders, are paying for that. We're paying for that out of the earnings and the retained earnings and the retained assets of the company. So I want everyone to take a little bit of pride and comfort that when you see your stock price fall, it's not nice, but in some ways we are making a sacrifice to help support those employees for those companies in which we are shareholders. Very, very important point. when those managers of those companies decide that they're going to put in place and take measures, whether it's federally mandated or they're doing it of their own accord, we as shareholders can stand tall, and we are heroes when we do that. And that's another reason we shouldn't be selling our stocks. We should own them with pride. Shock service industry crash, right? I mean, these are service industries that tend to be populated with lower wage employees who are least able to absorb this. And of course, this is what the Congress is thankfully focused on squarely, and that's good news. I don't know about executive leadership and trust. I think probably a lot of things the administration is doing are right now, finally. It looks like they've got some pretty good experts that are, maybe even some of the world's best. I don't know, it's not for me to say, but it doesn't seem to be the case that what's coming out of the Trump administration is calming the markets. It's just a fact. And there's lack of global coordination. If we think back to what the United States used to be, the leader of the world, it's not hard to imagine that there would be American leadership that would speak out to the rest of the world and put in place coordinated plans with the rest of the world that would calm markets. So these are negatives, and I think that should be obvious and clear. Certainly the markets are saying that. There are positives. Bank balance sheets are strong right now. Congress is taking what looks to be the most concerted action that Congress has taken on anything in a long time, and they sure as hell better. Internet technology and commerce. I want everybody to think about what it would be like if we didn't have this incredible internet technology. Hannah, my wife, is a therapist, and she had a call today, also using this system that we're using now, the Zoom RingCentral system, and she was having some trouble with her practice management software that does her scheduling for appointments and billing, and she needed to get some help from one of the people at the software company. So she was on with a technical support representative, a young lady who was talking to her from Los Angeles. And the young lady's husband was working on his remote business stuff in the living room, so she was working with Hannah from the bathroom. She was providing technical support to Hannah on this billing practice management software from the bathroom. So we need to consider that commerce continued. This internet technology and this remote technology, as frustrating as it may be to get it working right and so on, it is allowing across vast swaths of our country and the world for business to go on. This would not have been the case had this virus hit 50 years ago. The whole place would have been shut down completely and utterly. So we are in many ways very lucky that this is happening now, and we have the ability to communicate and to transact through the internet. Consumer debt levels are relatively low, having been worked down from the 2008 period. So that should help alleviate some stress. Treasury rates are very low. The federal government can borrow almost any amount at the very, very lowest rates, and it should, but it has to do the right thing with the money. No more invasions of Iraq and other boondoggles that have occurred. The government needs to make clear thinking decisions with what is done with the capital that it can borrow. The Federal Reserve is acting very expeditiously to backstop every place that it needs to. The 2008 run was practice for what's going on now, and in many ways the Federal Reserve is now very well prepared to backstop what it needs to backstop, which right now is a lot. Could be municipal bonds, other things. Markets are functioning. They are stressed, but they are functioning. And as I said, everybody should be very, very pleased that we have functioning markets. Concerns, governments, mass unemployment, I'm sort of repeating myself there, mass psychology, individual psychology, they're going to be losers, obviously. Travel business, airlines, hotels, cruise, rideshare, planes, public transportation. What becomes of public transportation? I don't know. Food, restaurants, and bars. Can restaurants survive on takeout only, at least for 2 years until we get a virus? The oil business. What about the oil business? As we now see, there is no protection or very little protection in having our own domestic oil industry if it produces at a much higher cost rate than Saudi Arabia. That industry has been hit with a double whammy. First, the coronavirus, because planes and automobiles use oil, and nobody's driving now and nobody's flying. And then a price war between the Russians and the Saudi Arabians, with the Saudis opening the taps. And so as we see an industry that is a commodity-based industry, even if we have vast production capabilities that we have put money toward, fracking in West Texas, they will go out of business more than likely if there is a producer of such size as Saudi Arabia that can suddenly drop the price. And look at all the money that has been invested. One of the reasons I sold the Fidelity floating rate bond fund from so many of your accounts is because it was not that fund, but that area was involved in lending to that area, the oil exploration business. And I didn't want to stick around even if there was a slight chance that there would be defaults there. What about the entertainment business? Sports arenas. I guess we're going to be watching games that are televised, but there's not going to be any crowd cheering, or it's going to be like cheer tracks, like laugh tracks are going to be on it. I'm sure that that's what we're going to see develop. Music arenas and clubs, gyms. What about gyms? I'm going to miss my gym if I can't go to it, and they're shut down. Real estate is of great concern right now. Retail. Many retail, publicly traded retail stocks have been cut in half. What about offices? If people get used to working remotely and it works out that way, and we develop that new paradigm, will people go back to being co-located in offices? Residential. What about houses? Don't know what that market's going to be. Really don't know. On the one hand, people may be saying, I don't want to live in an apartment building. I'm worried about the virus. I'm going to buy a house. On the other hand, they may say, not now. I don't want to make that kind of investment. There'll be winners. Information technology clearly is to the rescue right now. Automakers actually might be winners because people are going to say, no, I want my own car. I don't want to ride share, and I'm not going to take the train, right? And so right now, while people are delaying large purchases in automobiles, the long-term health of the automobile business might be strong. Industrials, I think most people believe, are going to be strong. Generally, manufacturing takes place in a spaced-out environment, a lot of robotics, a lot of spacing, and it's one of the reasons why I think people are not more panicked about the food supply and the supply for goods, is because a lot of that's being made in an environment where it's not conducive to the spread of the virus. There'll be some winners in real estate, warehousing, and industrial. The mutual funds that I put you in are highly diversified. Yes, they include some office buildings, but they also include warehousing and industrial as well. So that's a benefit from diversification. Consumer goods. If I can't go to the gym, then I'm probably going to spend like crazy to set up my own home gym. Those people are probably, their phones are probably ringing off the hook right now. How do I get a little mini Pilates machine? And cooking. If you can't go to the restaurant, everybody's going to be cooking. I'm sure everyone's now finding out how to make stuff if they haven't before. I'm going to have all the appliances to be able to prepare food. I said cars. What about campers? People may say, I need some sort of small camper that's only mine, my personal habitat space, and I'm going to go travel to national parks. I'm not going to fly, and we may see winners there. So there are going to be winners. Big changes: societal, political, infrastructural, financial, geopolitical, healthcare, educational, social. These are just some I could think of. Every one of these things is going to be affected by this virus, and not all for the worse, many for the better. I hope everybody will see that. Take political. We've talked about having the ability to vote remotely or vote over the internet for a long time. Many countries have that. Many advanced Western democracies have the ability to cast votes safely and securely. We don't have that in the United States. And so now, suddenly that's coming back into view. Climate change, I think, is going to become eminently more addressable now. What we've now seen is that a little virus starts somewhere across the world, makes its way here, and a few weeks later, whammo. Well, it can be the same thing in environmental terms, and I think it's going to be addressed now. I think if the United States drags its heels, once the virus settles down, all eyes are going to turn to dealing with climate change. And the oil businesses are in very weakened positions to try to fight back against that. One last thing, and then we'll open it up to questions. The IRS has been making a lot of changes over the last few days. Your 2019 tax filing, your 2019 tax payments, I think up to $2 million, and 2020 quarter one estimated payments have been extended to July 15th. And so you may want to think about deferring your payments on those. You don't have to, but you do have till July 15th if you want to. It is not clear yet. We're still trying to find out and are watching to see if 2019 IRA contribution deadlines will also be extended. They are generally the same date as the tax filing. My guess is they will be extended to July 15th, but it hasn't been announced yet. We will keep you informed on that. Okay, that's it. I'm going to go ahead and open it up to questions right now. And it looks like I've gone about an hour, so that's not too bad. And Catherine, why don't you jump back on and let me know if anybody has any questions. There were some questions sent in before the webinar. One person asks, I've not been able to bring myself to look at my portfolio, but given that I am 66 years old and don't have a long horizon to bounce back, should I be taking action to protect myself, even if it means that I will experience losses? My answer is, call me. Let's have a conversation. Okay? You're not alone. We can talk about this. So there's a lot in that question, and we need to have a discussion about it. All right? Another question, in what ways should we be thinking about investing during this volatile time? My first inclination is to hang tight and assume the market will correct itself in the long run, but there are certain struggling industries, travel, hospitality, etc., we should be looking at investing in. And my answer is yes, we should be looking to invest and hold on to our stocks. I hope that everybody's heard that message. If you need to raise cash, I'm happy to do that. We can do that. But we should be looking to invest in the market. I wouldn't be investing in any particular industries. We don't know what's going to happen with travel and hospitality. I couldn't even begin to predict it. I'm sure there are, really high-risk investors out there who are willing to buy up those securities at distressed prices. And if you're interested in particular names, I'm happy to buy a couple of it, but I don't think we want to put the majority of your wealth in it. Okay, Catherine, any questions or comments?
Question one has come through. What are your thoughts about how often we should look at our portfolio in these volatile times?
It's a great question. It's a great question. Thank you very much for that question. Whew. Let me see if I can answer it. Not too little and not too much. That's going to vary for everybody. You got to decide what too little and too much is. I don't look at mine very really ever. I'm not sad. There may be a year that goes by I don't look at my portfolio. Why? Because I'm invested in things I know and trust in the market, and I'm a long-term investor. Only you know what too much and too little is. All right? But if there's a little voice inside your head that is saying, I'm looking too much, then you're looking too much. And it's not good for you. All right? So you'll need to work that out with yourself. Everybody's different, and I'm not going to give you any, there's no rule of thumb. If it is becoming counterproductive and hurtful to you, and it is hurting you in your life, it is preventing you from doing the things that you like to do, it is becoming an obsession, it's taking you away from going to the gym, if it is pushing you into a state of depression, then it's too much. All right? So it's a great question. And if you want to talk specifically with me about it, I'm happy to. I'm happy to get into specifics. You can tell me I'm looking 15 times a day, and I will work out a plan with you for looking at your money. Happy to do that. We can set up a plan, and you can execute that plan. And you can push back and say, well, no, you're letting me look once a week, but I'd like to look twice a week. Fine, whatever. Use me to help you do that if you don't think you can do it yourself. But do not make yourself miserable. Do not ruin your life by looking at the markets right now. All right? The markets will be back. I can tell you 10 years from now, the markets will be higher. I can't promise that because it's against federal regulations for me to make that kind of promise. But if you held a gun to my head right now and said, our markets, stock market going to be higher a decade from now, I said, absolutely. No question about it. Okay, next question.
Okay, next question. Are you actively working our accounts even when we are not speaking with you regularly?
Yes. Yes, I indicated that early on in the presentation. Yes. Yes.
Okay. 2 more questions so far, and feel free to keep them coming. Next question is, how are you talking to your children about this situation?
Wow, that's a good one. Well, I have to say we're in Colorado, and we're not trying to shield them from it. They got on a plane the other day, and they're 13 and 15. So, they're not 3 and 5. They, they know a lot. We got on a plane, and they disinfected their armrests and seats and so on. And by the way, there were only 35 people on the Southwest 737 from Houston to Denver. I mean, we had the whole back half of the plane. It was that, which is a concern. These businesses can't keep going like that. What we have said to our children is this is a very difficult time for a lot of people. And we want them to be aware of that. We want them to be sensitive to that. And we want them to be helpful. That is the word that we are using with them. We want them to be helpful. And I think that's the way everybody needs to look at this. Everyone needs to think, how can I help? And I think if we all think that way, we're going to be fine. So thanks. That's a great question.
Okay, and one more that's in so far is, was your Bridgewater chart the global market or the US market?
As the US market. But global markets are even more on sale. They were already on sale more than US markets before the virus. They're even more on sale to US markets now. But yes, Bridgewater was showing US earnings per share. Mm-hmm.
Okay, there's no other questions in right now. So I believe that is it.
Okay, thank you, everybody. Thank you very much for taking time. We will probably do it again, maybe next week. My guess is we will. And it's been a humdinger of a week. It really has. I mean, it's been something else, and we're all headed into a really uncharted waters with quarantines, lockdowns, and so on. And so thank you for being with me tonight. It is a pleasure to be with you and to help to take care of you and your loved ones. And as I said, I think the last question we got about what I'm saying to my kids and to be helpful is exactly where we all need to be. So thank you for all the help you give me. And if I can help you at any time, please let me know. Thank you, and please go out and try to have a good weekend. The markets will not be turned on Saturday and Sunday, so go take a walk. Thanks, everybody.